Good afternoon, ladies and gentlemen, and welcome to the Oakley Capital Investments Limited Interim Results Investor Presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and we'll send you an email when they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll, and if you'd be so kind as to give that your attention, we would be most grateful. I'd now like to hand over, if I may, to Stephen Tredget, partner from Oakley Capital Investments. Good afternoon.
Afternoon, and thank you for joining this Oakley Capital Investments interim results presentation. As Mark said, my name is Stephen Tredget. I'm a partner at Oakley Capital. For those less familiar with OCI, Oakley Capital and listed PE, I have covered an introduction to some of these topics in a previous IMC presentation. But if I summarize the key points, Oakley Capital manages private equity funds, specialize in taking majority stakes in medium-sized European private companies with a sector focus of technology, consumer and education, and an overarching theme across those of digital delivery. Oakley Capital Investments, or OCI, is the publicly listed company we're here to talk about today, who releases interim results on Thursday. And OCI invests exclusively in the funds that Oakley manages and allows private investors like you or I the opportunity to get exposure to private equity returns through the stock market. So if you buy an OCI share today, you'll have a look-through investment in each of the portfolio companies that currently sit in the Oakley funds. And today there are 21 of those. Why should you wish to get exposure to private equity as an asset class in general? There are three reasons, high-level reasons as I see it. One, PE captures a much larger pool of companies than the public market, presenting a greater investment choice and opportunity in sectors or companies that may not be represented on the stock market. Two, unlike public market investors, PE investors play a meaningful role in the creation of value. So in doing so, have a significant or more significant control over the outcomes. It's this support that is actually part of the reason why so many companies are seeking private capital backing, and why so many more companies are staying private for longer or private for their in entirety. And then thirdly, and I guess most importantly to this presentation, is the superior returns achieved to date by the asset class, over all asset classes, and particularly over public market indices. And it's that performance which OCI has proven to be a good proxy for, which takes us to today's topic. It's been another period of sustained performance for OCI, thanks to repeatable origination and strong EBITDA growth which is the result of an investment portfolio focused on digital delivery of products or services. The key stats here, which were known before Thursday, but to repeat the headlines, despite COVID and FX headwinds and some cash drag, the company recorded an 11% total NAV return in the first half of this year, and 26% return for the last 12 months, exceeding an increasing 5-year CAGR that now stands at 17%. As the NAV per share bar chart shows, performance momentum is building thanks to an established portfolio and a focused investment strategy. More importantly, while the share price may lag the current NAV per share, it is, however, reflecting the NAV growth with total shareholder return of 28% in the period. Driving 75% of portfolio value in the first half was EBITDA growth. And that EBITDA growth was an average of 35% per portfolio company in the last that's the last rolling 12 months. We've highlighted some examples here of those enjoying high growth, companies like Wishcard, who has seen their multi-retail gift voucher double over the last 12 months. Or 7NXT, whose fitness app Gimondo has seen a circa 70% increase in subscribers to its online gym classes. Multiple expansion, i.e. the increase of the EV/EBITDA multiple that we apply to a portfolio company, drove 25% of portfolio value. The most notable company which enjoyed high EBITDA growth and a modest increase in EV/EBITDA was IU Group, which alone added 15 pence to the NAV per share, driven by the increasing adoption of digitally delivered degree courses. As previously mentioned, there are some headwinds. 7 of the portfolio companies are trading at or below pre-COVID budgets, and that has impacted NAV in the first half by 4 pence. FX headwinds have also reduced NAV by 14 pence. Let's now break down the NAV and the constituent parts of the investment portfolio. I'll canter through this slicing and dicing of the assets, but based on June valuations, OCI currently has a total look-through portfolio valued at £766 million. It has 172 million of cash on the balance sheet at the period end, and both are offset by 134 million of liabilities, and they're largely fund facilities within the Oakley funds. The net of these three numbers is the 804 million of net asset value that we report. Now, the cash compares to outstanding fund commitments of 438 million. To explain a fund commitment, OCI essentially commits to a new fund that Oakley manages. Let's say it commits £100 million to a fund, and then that fund will draw down the capital as it's required, as it makes investments. And so that is the outstanding commitment that's currently been made to the funds that currently Oakley manages. All those funds are very open on a chronological basis. As one completes, another one opens. And so there is that level of commitment across those funds. It is, however, estimated that of this number, only 244 million is likely to be drawn. And this takes into the consideration the use of facilities at the fund level, the fact that some portfolio companies might be refinanced and that those funds recycled, and it also takes into consideration the final level of drawdown, which is likely within Fund 4 and the Origin Fund. They're the two funds currently being invested, and the ones that make up the largest chunk of that 438 million. Over the slide, the assets are split with 615 million held via the funds, those Oakley funds, and 151 million of direct portfolio investments, which includes 111 million of North Sales debt, and the residual being a direct equity stake in Time Out. The board of OCI have confirmed that the intention is to realise these direct positions and expect them to be wound down within the next 12 to 24 months. As you can see on this slide, our equity positions are evenly split between the three focus sectors of technology, consumer, and education. Those pound millions numbers are the look-through exposure that OCI has to each of those companies. And you'll see that there's no pronounced single company exposure risk. The largest exposure is to IU Group there, with just under £100 million exposure to that particular company. I mentioned the company earlier, but to provide a little bit more detail, this is an EdTech platform that can deliver multi-topic degrees to people in work anywhere in the world. It is principally based in Germany, but essentially its students now come from all over. Let's give a few more stats. It will offer by the end of the year 340 degree programs. That's the flexibility it provides if you're not restricted by a tutorial schedule or the restrictions of lecture halls, etc. It now has 75,000 students. It makes it the largest university in Germany, up from 17,000 in 2018 when we acquired the company. I think what's most notable is that 70% of those students are from non-academic households. So it's democratizing access to education. And also, for the future value of this business, 25% of those students are international, from something like 110 different countries, a number that's expected to reach 35% by the end of next year. The target is for IU Group to become the largest university in Europe in the next 3 years, and we expect it to be a key driver of OCI's NAV in the coming years. Keeping with stories like IU's, a consistent theme across the portfolio and sectors is Oakley's investment in tech-enabled companies, with 14 of 21 companies delivering their products or services digitally. And in the majority of the remainder, we're exploring the adoption of digital solutions as part of the investment thesis. Related to this theme is the 16 of 21 companies that enjoy an increasing level of subscription based on recurring revenue, with the benefit of the visibility this provides and the rising valuation multiples it attracts. Finally, as you would expect with a portfolio positioned as ours is, the majority of the companies, 14 of 21 of them, are trading at or above pre-COVID budgets. But there is some post-pandemic recovery, so we look forward to that from the remainder. Let's look now at how Oakley is approaching investing and its success in sourcing so far this year. I'll attempt to summarize the key things that Oakley does in this one slide, or at least how it differentiates itself. Firstly, and most importantly, is how it approaches sourcing. Its relationship investment style has built a business founder network that provides repeated opportunities to back proven talent. It attracts entrepreneurs new to Oakley, and in turn, they have demonstrated their belief in Oakley by investing themselves in the Oakley funds. Of the funds that Oakley manages, just shy of 200 million euros of that has been committed by the managers, the entrepreneurs that we've backed. It's a great alignment of interest. They've had a positive experience of working with us. They've committed some of the capital they've managed to accrue as a result of a successful sell down their business, and then they've gone on to commit that to the funds. The two most important outcomes of our approach, and that network and the fact that we draw in such high quality entrepreneurs, is one, the sheer quality of the management we're backing. I mean, maybe that's an obvious thing to state, but it's one of the single biggest drivers of our investment success, and we very rarely change the management over the course of an investment, in contrast maybe to broader themes within private equity. And secondly, by virtue of many of the deals being off market, and that we're often the first private equity capital investing in a company, we see less or no competition for assets. And this is reflected in the below market multiples that Oakley pays. The second column here I've highlighted is Oakley's active management, which plays a significant part in value creation. Drivers include human capital management, digital acceleration, improving quality of earnings, marketing excellence, and transformative M&A. Buy and build has proven to be a highly effective way for Oakley portfolio companies to scale up by adding new products, services, and customers, entering new markets, and of course, creating synergies. The 40 platform companies that Oakley has invested in since its inception have now made over 100 bolt-on deals to date, and it's been an incredibly effective way of creating value. And then there's the investment themes. In this case, I've defined them in terms of the significant global trends that we're investing behind, with the most notable being the growth of global internet users and the accelerating adoption of consumer and business digital solutions. And that we're playing this particular theme in a whole range of ways, whether that is digitalization of companies in general, providing direct-to-consumer channels, SaaS solutions, and also repeat regional plays where we see the digital the maturity of the adoption of a digital solution in a particular country. Let's say in the UK, which is quite mature from a European standpoint, and looking to invest behind the digital disruption curve in a number of countries, particularly in Southern Europe at the moment, which is behind that maturity curve. On the subject of M&A, the Oakley funds made 3 transformative bolt-ons in the period into 3 of its platform deals. Firstly, the acquisition of Primavera alongside Econ and 4 other acquisitions have created Grupo Primavera, and in doing so has made the largest independent provider of business software in Iberia. Secondly, the acquisition of Compass, the leading crew management SaaS provider to the maritime industry by Ocean Technologies Group, has brought this group to a stage where it is now the leading software provider to the maritime industry, serving around 20,000 vessels and over 1 million seafarers every year. The group includes the clear market leaders in e-learning, human capital management, fleet and information management software solutions. And finally, Winstar Medical acquired Lab Cosmetics. Now, Winstar is Germany's leading over-the-counter consumer healthcare company, and the strategy here was for us to scale the business through continued product innovation, digitalization, and accretive acquisitions. We've essentially achieved all 3 with Lab Cosmetics, which is the leading provider of clean beauty products, a high growth segment with a fast growing D2C channel. Here on the screen are the 4 companies, the 4 new platform deals that Oakley acquired in the first half of the year, or the year to date, I should say. First up, the top corner there is Idealista. Now, this is Southern Europe's answer to Rightmove and Zoopla. Its digital penetration amongst consumers in Italy and Spain is far lower than Northern Europe. So the exciting opportunity for us is to see that adoption continue to meet the kind of maturity rates that you might expect in somewhere like the UK. Following our online real estate sector experience in a number of companies like Idealista, and we've also recently invested in Dexter's, which takes us to the offline world. This is a business that's performed consistently over the cycle and has a 75% bias to lettings and the visibility that brings, and it operates in what is still a highly fragmented market. The opportunity we've identified amongst many is that there is a chance to make Dexter's multi-channel and essentially allow it to capture a section of the lettings industry, that low touch, lower cost service solutions for the lettings industry, so that they become omni-channel and go across the full lettings value chain. Thirdly, ICP is the 3rd largest children's nursery group with nearly 6,000 children at 44 nurseries across England. The UK nursery sector is nearly 7 billion in market value, serving an estimated 850,000 children across 15,000 nurseries, most of which continue to be owned and operated on a single site basis. The market has grown steadily at 5% CAGR across the last 10 years, and that's been driven by rising female labour market participation and that increasing awareness of the importance of early years education. And then finally, there's e-commerce one. It's an e-commerce software roll-up opportunity. We've acquired 2 of the leading software solutions for German online merchants selling via marketplaces. It's a suite that allows these merchants to manage, simplify, and automate all the back-end tasks involved in running an online retail business. It provides core functions like the listings on multi-channels, order processing, sales, and fulfillment. I think it's clear about this kind of 4 companies that they're all in our sweet spot of sectors and with either a digital focus or an opportunity to digitalize. I think the other key thing is the value that we're acquiring these companies at. To give you some sense, in Fund 4, which is the fund that we're currently deploying at the moment, it has 8 investments. The average multiple we paid for companies in that fund is about 12 times EV/EBITDA. And that compares to the comparable multiples of those businesses amongst peers at being roughly around 16 times. And the average EBITDA growth of that fund 4, is now over 40%. Just taking that kind of origination strategy a bit further and giving you one example of e-commerce. and how we're managing to achieve those kind of valuations, or that we are able to achieve them, is that one, e-commerce is is in a really target sector for us, but a really hot sector for many people. I mean, it's in software, it's a digitally native business, it's in e-commerce. I mean, it's absolutely, and it's in a kind of strong European country in Germany. All the things that make it highly desirable. Secondly, how we've sourced it is via the Oakley network that I touched on earlier. We're backing Valentin Schutt, who we backed previously in one of our other portfolio company investments, Wishcard. So it's his willingness to continue to work with us, to make introductions to us, and one of the two companies that we acquired here, Valentin was a founder of. And because of a combination of the roll-up approach that we're taking, our relationship with Valentin, and how fast these businesses are growing, we've acquired this business on a single-digit EV/EBITDA basis. And we think it's that our approach that is able to not only achieve these attractive valuations, but more importantly, it's going to mean that we can keep repeating it as well, which I guess is key to the future performance of Oakley funds and ultimately OCI. So to bring this part of the presentation to a close, I'll touch on ESG and closing the discount. On the subject of ESG, Oakley has been focused on asset-light, low-impact companies. So it'd be easy now to claim a really strong green agenda. We won't. But what I would say is that Oakley has had a long-held ethos never to invest in something that could prosper from the misery of others, and has been alive to the risks of companies that don't operate in a sustainable or ethical way. The difference, I think, for Oakley in the last year is that we have formalized our approach, and we've integrated it far more into the operations of the investment manager, whether that's as a part of our investment process, portfolio company reporting, hiring at Oakley Capital, or its carbon footprint strategy. We are, of course, not alone in this approach within PE as an industry, which I happen to believe kind of leads in this particular area versus the public markets, despite a reputation in the media to the contrary. And look, I've included a couple of stats there that I think bears out the sustainable and growth approach we're taking. In 2020, the portfolio companies that we invest in created 331 new jobs in that time. I'm really pleased to say that another one of our companies, North South Apparel, has just got B Corp status, which is the highest accreditation in the ESG sphere. So to closing the discount, it's an often talked about subject with Oakley, principally because the NAV per share or the share price, sorry, lags the NAV per share at this point. I touched on it earlier, but I mentioned it again. I mean, I think it can sometimes be a bit of a red herring. I mean, the key driver of performance of OCI share price is its NAV growth. This is a growth opportunity, and that growth has driven the shares are tracking that growth, and we've seen that with the 28% total shareholder return in the first half alone. However, it is the desire and the drive of OCI and its board to close that discount, and we continue to identify ways to continue to do that. This chart here, this slide here lists in green the areas that we have either tackled or introduced in order to close that discount over time, and where we're continuing to maintain a policy. Amber shows well, we've started something, but there's still work to do to reach our required level. And red is really an area where we've yet to do it, but we think it's something that could really help close that gap. Just to focus on some of those red or amber points, I think key, as I mentioned it earlier, the direct investments that have been made historically and monetizing those. Why do I think that's important? I think the direct investments have historically lagged the performance of the Oakley funds. So I think the more of OCI's assets can be invested in the funds, the better frankly. And secondly, it creates a certain level of confusion and also raises questions of conflicts of interest. If they're removed, I think that will be very positive for OCI. Share trading volume is increasing all the time. The more the share trade, the closer we're always going to be to fair value. The bigger the company gets, and the more opportunity to trade, the bigger we get as well. We attract, kind of wider range of investors. I think that all works towards the right outcome. And then there's your appropriate listing. We did move from AIM to the full list, but we are currently designated a SFS company. We're on the SFS listing. And in time, we'd hope to move that to the main or premium list. I don't have a date for that, but it's certainly something that's always under review. And let's hope that's something that we can achieve in the next 12 to 24 months. Accessibility, look, we're really pleased and proud of the way our investor materials have come on over the last number of years, and that's really been borne out by the award from the AIC earlier in the year, giving us the best report on accounts for this asset class. Our profile and communication, look, we try and do as much as we can now to communicate to a wider audience. That's why we've been so pleased to come onto the IMC platform. But still, our profile is less known compared to some of the other direct listed PE peers, a 3i, let's say, or an HGT or an APAC Global, all of which are either trading significantly above their NAV or close to it, despite the fact that their performance is very similar in scale to OCI's. And finally, we report on a half-yearly basis. Well, that produces long periods where the market can't be certain, despite our track record, of how strong the NAV performance is over that period. And so moving to quarterly NAVs would provide more confidence, I think, to investors and more up-to-date information, which I think will be of help. Our aim is at the latest to move to quarterly reporting for Q1 next year. So moving to the conclusion, there's a lot that gives us confidence in the performance of OCI in the second half. I mean, we've got this tech-focused portfolio that continues to benefit from accelerating megatrends. From a cash perspective, we're well placed to meet OCI's commitments to the Oakley funds as they make new investments, and also in a position to be able to further commit to the new Oakley funds as and when opportunities arrive. One of the things that will no doubt drive a share price of an investment company in between reporting periods will be news announcements, news events. And look, we anticipate this to be an ongoing period of significant activity, and we have strong prospects for the investments we have and for making new investments and for realizations. Just on that realizations point, of all the companies we've sold to date, the average holding period was about 4 years. And the average holding period of the 21 companies that we have today is about 3.5 years. Now, I think if we've got great performers, we absolutely want to continue to hold them for as long as possible. But you'd imagine if you don't see realizations in the next 6 to 12 months, which I'm sure we will, you may see some refinancings maybe instead. Thank you for listening to the presentation. And I'll now take your questions, if I may. We've got 2 pre-submitted questions. Does the board have a target discount level? I think ultimately the board wants to see the discount closed. I think that's its kind of minimum target level, is no discount. I think thereafter, what it should trade on beyond there, based upon the continued NAV growth, consistent NAV growth of this business, and also, if you note, the premium at which Oakley sells assets beyond what it's holding them on the book is significant. I mean, the average premium to book of a realization since inception is 44%. That number was actually over 80% in 2019. So you have what on the surface is a particularly conservative NAV. The very least the share price should be doing is trading at that price. Another question: you do not appear to have an investor relations page on your website. Is there a reason for this? the Oakley Capital Investments website is essentially being created as an investor communication website. So there's a lot of investor relations material. I think the confusion here may be that Oakley Capital has a website. Now, Oakley Capital doesn't approach investor relations in the same way. It has a very relatively small and focused number of investors which it communicates with directly, and it's not a public. It's obviously they're not publicly available funds. Oakley Capital Investments.com is the website you want to go to, and that has an investor center with all the docs that are provided, from research materials to the results themselves to fact sheets. It also has a range of videos that we have published on OCI, and also there is the news feed on there as well. How long do you think it will be before Fund 4 is fully invested and Fund 5 put on the launch pad? I can't publicly comment on Fund 5's launch. Richard, who asked the question, I can tell you roughly where we are in terms of Fund 4. Fund 4 is 60% invested, with 8 companies currently, and we'd anticipate that with another platform deal, kind of likely in the fourth quarter, that should take us to 75%, which is kind of designated as the kind of initial kind of investment phase of Fund 4 complete. You'd expect the residual to be funds that can be drawn into the roll-up opportunities that currently exist within Fund 4. Richard asks, in the most recent past, how are the 7 portfolio companies doing that have been COVID affected? Well, there's been a significant bounce back as a result of kind of coming out of lockdown. I won't speak about all 7, but in the main, there's been recovery across all of them. Whether that's kind of now Schülerhilfe, for example, that was after school tutoring of children in Germany. Clearly now exam systems are back. Children are now in schools. There is now a much more greater propensity to enroll for services like that, and we've seen that run rate return. As in North South, as sailing has returned and outdoor action, adventure actually has become one of the things that has actually started to kind of really pick up during COVID. So we've seen the performance of North South recover. A lot of the other disruption was, in companies like Grupo Primavera and Daisy, which is the ability to get on site, or for a company amongst the disruption to take on a much larger project. Clearly, with lockdowns removed, that the wheels can turn again on the sales cycle. Andy asks, which underlying investee company excites you most? I'd say IU Group. Hopefully that was borne out in my little segue. I mean, I think it's in for all manner of reasons. It's its annual revenue and EBITDA growth. It's the defendability of its position and the fact that it's kind of best in class as a real sector champion within Germany, and it has clear drivers in order to attract kind of new students, whether that's the quality of the product it provides, the number of different courses it can make, adapting them to the needs of essentially any 25 to 45-year-old in work who either didn't get a degree, couldn't afford a degree at the time, or wants to take a new degree, potentially a degree that is much more suitable to the career progression that they're now interested in. The scope of that business is huge, and the level of international students that are now signing up for the service really gives us hope that it can spread, much beyond the scope of the German market or the German degree market that it currently serves. It's also the largest holding in the fund, so it can have the most in OCI across the portfolio companies. So it can also have the most impact given its current outperformance. Richard asks, will proceeds from the sale of North South and Time Out go back into the Oakley funds, or will you make direct investments? I think the easy answer to that is OCI and the OCI board has no intentions to make further direct investments. All capital it has will be dedicated to the Oakley funds. So any return proceeds from any sale, be they the current direct investments or the funds, will be directed towards the Oakley funds in the future. Mark asks, in the education sector, do you expect any significant fee reduction following the Chinese crackdown on online education? No is the immediate answer, principally because we don't serve the Asian market. We're very focused in Europe in very specific areas, whether that's after-school tutoring in Germany, vocational training for adults in France and Spain. It's the Ocean Technologies Group, the kind of e-marie learning, crew management software group. Nothing that either touches those areas, touches the age group that we're discussing there, and certainly not anywhere near Asia. The open cost of IU Group is stated at 0 million, but the fair value is stated at 99 million. How is this explained, please? So the open cost is essentially, James, the amount we paid for the asset at the time in which we purchased it, the look-through amounts for that OCI when it was paid for, less any refinancings. So if the business was refinanced or there was debt put into the business, and that debt is that is then cash that is returned to the fund or to investors, it nets off that. So essentially, the original amount invested, we've received that back by way of refinancings, and so the fair value today is the value, the look-through value of the equity stake of OCI. OCI has roughly a look-through equity holding about 25% of IU Group, so a meaningful amount, and that's currently valued at £99 million. James also asked, there is 110 million in debt due to North sales. Do you anticipate this will be recovered at the same point as the sale of the equity stake, which will suggest will be in the next 12 to 24 months? So there's no direct equity stake in North sales. We have a direct debt stake in North, and we introduced debt when OCI was first launched. We had a lot of cash post the GFC, and we were waiting to deploy that. We thought there'd be a lot more opportunities post the GFC, but banks kind of kept the lights on a lot of businesses for quite some time. In order to stop that drag, we lent into the portfolio companies, and particularly those that kind of could justify paying an attractive rate for kind of mezzanine short-term lending, which we rolled. The last piece of that debt is to North sales. We've probably lent them a little bit more over the last couple of years, and COVID's obviously meant that there's kind of more losses to fund in some of the divisions within North sales, which is why we've kind of increased that slightly. We'd anticipate that the equity stake in North is held via Fund 2. We'd anticipate that business will go through some kind of structural change, possible sale, possible IPO, SPV, whatever it is. The primary focus of that process is the refinancing of the business and the repayment of the 110 million of debt to North sales. And yes, in your question, could this be the next 24 months? That is absolutely the intention of that process. Mark asks, other than a brief mention of timeout, there was a very little commentary on the investment. Given its contribution to NAV, can you please elaborate more on this? I guess the first thing to say is that with timeout being public, it's a rare situation for us to be in. The whole point of investing in OCI is to get access to private companies. Timeout is listed. It was listed because it needed additional funding that Fund 1, the fund it was in, couldn't provide at the time because it was end of life. So the public markets were used to finance the business. And of course, being public, there are restrictions around what we can say about it, but it obviously has its own communications with the market, and it will be reporting its results sometime over the next month or two, when you'll be able to get more detail. The reason for the driver in the performance is entirely based on the share price. The share price rallied from approximately about kind of 38p at the start of this year to something more akin to it's currently trading about 58p at this point. And so that increase in the value of the shares is exactly what created the 16 plus pence of NAV contribution for timeout. Why did timeout shares rally over that period? Well, they've been badly impacted by COVID from a trading perspective, as you could imagine, with a company called Timeout when you couldn't go out. But subsequently in March, there was a fundraising for the business, which really put it on a sure footing and puts it in a position where we do not expect Time Out to require funding again for that business. I think that reassurance, plus of course there was, kind of a bounce in consumer-facing COVID-impacted companies over that time as people saw the impact of vaccines, saw the opening up of the kind of global economy, and the anticipation that companies like Time Out will benefit. They'll benefit in two particular ways. Time Out's traditional content, that authoritative, great global content about what's the best things to do in cities around the world suddenly becomes a very relevant source. People return out of information, people return to going out again. And then there's the markets, the real driver of the performance of Time Out from here on, which are these physical locations in 6 cities around the world currently, with a pipeline of many more to come, that basically have provided a physical location for the best restaurateurs, the best food and drink in any one city. The first of which was in Lisbon, generated a £6 million of EBITDA, generated Time Out £6 million of EBITDA in 2019. And they obviously had to close during COVID. They're open again now. They're under a certain amount of restrictions, and clearly tourism isn't flowing into these cities yet. But I think we're all confident that they will, and with it, kind of Time Out's financial performance will reflect that. I think there's a lot of optimism around Time Out at this moment in time, and it's just a case of emerging from this kind of COVID impact period to see their trading return again. James asked, can you expand on the 22 million of realised gains to the 6 months in June, please? Is this the net profit on realisation of IU Group and Daisy? Yes, it is. If you look at the RNS, James, we list the 3 areas this has come from. It comes from a realisation of, a refinance of IU Group in the period, and the sale of one of Daisy's divisions, which did 2 things. There was some funds that came in via Fund 2, which is where Daisy's held, and also there was a repayment of the direct loan to OCI. Mark asks, yield and dividend growth could be a possible element helping to close discount. Can you please confirm your stance here? The current stance of the board is to maintain a dividend, which is maintained currently at 4.5 pence. It's an ongoing debate in which ways to return capital, either through buybacks or through dividend. The general, in kind of discussing this with shareholders to date, the vast majority of them seem to much favour buybacks, for the reason that it's a much more tax efficient approach to returning capital, and that is has been to date at least the main focus, the buyback program, and we bought back a further 2 million shares in July. The dividend we're happy to maintain. We'll always review it as a strategy, but currently that's our stance. Chris asked, do you expect the direct investments to be sold above cost? Well, the North debt is the North debt. I mean, it's kind of got a clear value. It rolls up at 10% a year, and would expect the full amount of that to be repaid to us. Time Out is a listed company, so you can see the price at which that is listed, and how we sell down, the method of that is remains to be seen. Lee asked about whether the dividend should be higher. I think the other thing to say about OCI, and I completely understand, particularly in an environment where it's quite hard to get kind of interest income from any assets. I guess principally OCI is a capital growth opportunity. That's what we do. We grow capital. We don't, other than the debt to North, which in time will be repaid. We don't generate income which you would traditionally use to pay a dividend. I think that's one. I think secondly, we are very much focused on getting the cash where it gives us the most returns within the funds. I think thirdly as well, if you really want to close a discount by way of paying income, you have to attract the big income institutional investors to really have a weight of buying interest. And vehicles like investment companies like ours don't attract income investments, even if you were to pay a dividend, because for that exact reason. Income funds will look for companies that generate a guaranteed or highly visible level of income cash flow, from which they pay dividends. They don't invest in, or are unlikely to invest in, companies that pay dividends out of the capital that they generate, in our case, through realizations. So the debate is out as to whether or not a high dividend closes the discount. There are plenty of, there are a number of listed PE companies that pay a bigger dividend, but don't necessarily trade at a discount. Got 15 minutes left and quite a few more questions to get through, so I'll try and canter through these. You have two significant direct investments. Do either of these concern you? No, not at all. I mean, North actually is trading incredibly well in the first half of this year, and as a combined group, will be significantly profitable, and we've got lots of opportunities to refinance that, we hope, in the next kind of year or two, and the other one's time out, and I've already discussed the strong footing that is now on. I'm just reading the Richard asks, is North Sails the only debt you have? Yes, it is. He also asks, if you sell time out of North Sails when Oakley Capital is not in fundraising mode, would this act as a cash drag? How would this money get invested? Well, you don't have to be in fundraising mode in order to deploy cash. The cash actually is constantly being drawn on as any of the funds make investments over the course of any year. So it's not, the fund doesn't open and the cash is given to it. The funds, you commit to the funds, and then the funds draw on the cash over the course of time. So our cash is being drawn on, OCI's cash is being drawn steadily over the course of any given year. So there's always a risk of cash drag, and our performance that I've mentioned, right up front, that 26% growth over the last 12 months, something we think we can, we're in a very strong position to maintain, if not better. And that is done despite the fact that we have a cash pool that sits there ready to be drawn, a cash pool that may suddenly currently at 20% of NAV. The long-term average has been 15 to 20%. We achieved the performance in the last 12 months with at times having cash nearly as high as 30-40% based upon some big realizations at the start of 2020 and the end of 2019. And asked, do you expect more acquisitions similar to IU Group? I mean, I guess the answer is yes to that, in that we expect to continue to invest in EdTech. We expect to continue to invest in digitally native companies of this kind, and also into companies that kind of continue to grow at this rate. Certainly, we have a Munich office. We're very focused on Germany as a space, as we are across most of Europe. So absolutely. I mean, we won't necessarily be making another online university acquisition because we've clearly got the platform that we think is going to best play that particular theme. Richard asks, how many of the 21 portfolio companies are not profitable? Currently, as we stand, only one, which is Time Out, due to the losses currently the group is making as a result over the period of the COVID lockdowns. And then Mark, the final question is, given your reasonable points around dividend, why are you paying any level of dividend? Well, look, we introduced dividend because we did have some income funds back in 2016 when we introduced it. It was, look, it's seen as a good discipline for a company to make. So a dividend, although modest and maintained, is better than no dividend. And of course, once you've got a policy in place, it's easier to keep it and then continue to review it over time. Thank you very much for all those questions. I'll hand back to Mark.
Stephen, thank you very much indeed for addressing all those questions, and thank you also to the investors that have taken the time to submit questions. Stephen, I know investor feedback is particularly important to you and to the company, and we will shortly redirect investors to provide you feedback. But I guess before doing so, I could just ask you for a few closing comments to wrap up, and as I say, I'll redirect investors to provide you some feedback.
Thanks, Mark. I mean, I'll be repeating what I've said at the end of the presentation, but I think there are some just great non-cyclical, non-COVID related trends wherever your concerns may be over the kind of coming years, whether that's in the education space, digital space, healthcare space, which make the Oakley portfolio incredibly exciting. I think the other fear that people may have in terms of, aside from kind of economic cycles, is really, can you repeat this? There's a lot of dry powder often talked about within PE, particularly that sits very much in the global private equity funds. I think our advantage to that is that, one, we don't compete against them in the way that we access opportunities through the network of business founders that we work very closely with. Secondly, the benefit of that is that when it comes to realizations, we have very strong strategic relationships with those big PE firms, and they are predominantly the buyers, or have been over the last few years, of our assets. So we have a strong, kind of exit market to play into at the point when we see fit. We have a suitable level of cash, and we've got a strong pipeline of opportunities of investments that we are set to make over the coming months and years. And finally, when realizations do happen, they prove to be, kind of an additional push to NAV growth based upon the premium at which we sell our assets. We're incredibly optimistic about, kind of the OCI opportunity over the rest of this year and the coming years.
Stephen, thank you once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Oakley Capital Investments Limited, I'd like to thank you for attending today's presentation. That now concludes today's session, and good afternoon to you all.